You've heard it a million times. Buy the dip. It's rule number one in the investor's handbook. Buy low, sell high. Simple, right? But what nobody tells you is that the dip can keep dipping for months or even years, turning what felt like a savvy move into a giant anchor, dragging your portfolio down. So, how do you know when the market has really hit rock bottom? When is that moment of maximum opportunity? Today, we're cutting through the noise, ignoring the gurus, and doing something radical. We're just going to look at the data. We're going to analyze every single bear market in modern history to give you a definitive data driven guide on when to actually buy the dip. The phrase buy the dip is more than just advice. It's a rallying cry on social media, passed down from Wall Street pros to brand new investors. The logic is seductive. When prices fall, things are on sale. It's your chance to grab assets at a discount before they rocket to new heights. But anyone who tried to buy the dip in October of 2007 or back in March of 2000 knows the painful truth. Buying the dip isn't a single action, it's a campaign. And if you start that campaign too early, you'll run out of ammo long before the war is over. This isn't just about avoiding losses, it's about protecting your most valuable asset as an investor, your own sanity. The feeling of buying a stock only to watch it fall another 10, 20, or even 30% is one of the most demoralizing experiences you can have. It makes you question your strategy, your judgment, everything. It leads to the single most destructive investing behavior: panic selling at the very bottom. The real problem is uncertainty. When the market is in free fall, headlines are screaming about recession, and every expert is predicting the end of the world. It feels impossible to know if you're getting a bargain or just catching a falling knife. Is this a minor correction, or is it the start of a soul crushing bear market that could last for years? That's the question we're here to answer. Not with a crystal ball, but with something way more powerful: historical data. The market may not repeat itself exactly, but it definitely rhymes. By studying the anatomy of every major market crash of the last century, we can spot patterns. We can see how long it really takes for the market to find a bottom, the average depth of the decline, and how long the recovery usually takes. This video won't give you a magic button that screams, buy now, but it will give you a framework, a historical map to navigate the chaos. We'll arm you with the data you need to turn fear into a calculated strategy. So the next time the market tumbles, you're not a victim of the panic, but a student of history, ready to act with confidence. Before we get into the history, we need to be speaking the same language. Not all dips are created equal. Wall Street has specific names for different kinds of market declines, and knowing them is the first step. First, you have market noise. This is the daily and weekly chatter. The market's up 1%, down 2%, then up again. This is just the market breathing, and these moves are usually less than 10%. Trying to trade this day to day noise is a great way to lose your money. Next up, we have a correction. A correction is officially a drop of 10% to 20% from a recent market peak. These are pretty common, happening about once every couple of years on average. Corrections are often seen as healthy, shaking out some of the froth and bringing stock prices back to more reasonable levels. For a long term investor, a correction is often your first chance to buy the dip. But then there's the big one: the bear market. A bear market is a much more serious, prolonged downturn. It's officially declared when a major index, like the S&P 500, falls 20% or more from its highs. These are the events that define investing generations, and they often come hand in hand with an economic recession. Bear markets are born from a fundamental shift in mood, from optimism to widespread fear. This is where the real danger is. The average bear market since 1928 has seen stocks lose about 35% and has lasted around 11 to 15 months from peak to bottom. Think about that. If you buy after a 20% drop, thinking you got a great deal, history says you could still face another 15% of losses. That is the definition of catching a falling knife. And the math of recovery is brutal. It's a concept most investors don't truly grasp until they live through it. If your portfolio drops 20%, you don't need a 20% gain to get back to even. You need a 25% gain. If your portfolio drops 33%, you need a 50% gain. And if you suffer a 50% loss, which is gut-wrenching but happens in severe bear markets, you need a staggering 100% gain just to get back to where you started. This math, plus the psychological gut punch of watching your net worth evaporate, is what makes timing the bottom so hard and so important. It's not about nailing the exact day the market turns. It's about having a data-driven idea of how low it can go and how long it can stay there, so you can build a strategy that doesn't depend on pure luck. With that laid out, let's open the history books and dissect the big bear markets of the modern era to see what they can teach us. To really understand when to buy the dip, we have to learn from the past. Every bear market has its own personality, but when you look at them together, a bigger picture starts to form. We'll look at the key data: the total drop, the time it took to hit bottom, and the long road back to recovery. Case study 1: the Great Crash of 1929 and the Great Depression. Let's start with the grandfather of all crashes, the one all others are measured against. The setup: the Roaring Twenties were a time of wild economic growth and speculation. New technologies like the radio and the automobile fueled a massive stock market boom. Everybody was playing the market, often with borrowed money. Valuations were completely unhinged from reality, creating a historic bubble. The fall. The market peaked in September 1929. The crash started in late October with Black Thursday and Black Tuesday, a series of brutal single-day losses. But that wasn't the bottom. Not even close. The market would try to rally, sucking in hopeful investors before grinding down again and again. The real bottom didn't hit for nearly 3 years in the summer of 1932. From its peak, the Dow Jones lost a catastrophic 89%. A $10,000 investment would have shrunk to just over $1,000. The recovery. The recovery was an agonizing marathon. Because of the sheer economic devastation of the Great Depression, it took over 25 years for the market to get back to its 1929 peak, not even counting dividends. Historical lesson: the 1929 crash is the ultimate warning about speculative bubbles and what happens when a market crash triggers a deep economic crisis. It teaches us that the dip can be a chasm, and the bottom can be years away, not months. Case study 2: the dot-com bubble burst, 2000 to 2002. For a more modern dose of speculative mania, let's jump to the turn of the millennium. The setup. The late 90s was the birth of the internet, and it felt like a gold rush. Any company with a .com in its name saw its stock price explode, whether it had a real business plan or not. Investors, convinced that this time is different, chased tech stocks to insane valuations. The tech-heavy NASDAQ shot up 600% between 1995 and its peak in March 2000. The fall. The bubble burst on March 10th, 2000. As .com companies started running out of money and going bankrupt, panic selling took over. The NASDAQ began a brutal 2.5-year slide, finally bottoming out in October 2002 after losing a breathtaking 78% of its value. The broader S&P 500, while less tech-focused, still got cut in half, dropping nearly 50%. The recovery. The journey back was long. After its 49% drop, it took the S&P 500 until May of 2007 to finally reclaim its old high, a recovery that took over 7 years from the peak. For the NASDAQ, it was even worse. It took a full 15 years to get back to its year 2000 level. Historical lesson. The dot-com bust was a harsh reminder that valuations eventually matter. It also showed that even without a full-blown depression, recovering from a major bubble can take the better part of a decade. This reinforces a key data point. Big bear markets are often multi-year events, both on the way down and on the way back up. Case study 3: the global financial crisis, 2007 to 2009. This one was different. It wasn't about speculative stocks. This crisis hit the very heart of the global financial system. The setup. In the mid-2000s, a housing bubble fueled by easy money and sketchy lending gripped the US banks were packaging risky subprime mortgages into complex products and selling them worldwide. When the housing market finally turned in 2007, these products became toxic and the entire banking system was suddenly revealed to be dangerously exposed. The fall. The market peaked in October 2007. The initial drop was slow, but things went critical in September 2008 when the investment bank Lehman Brothers went bankrupt. That triggered absolute panic. From its peak to its terrifying bottom on March 9th, 2009, the S&P 500 plummeted 56%. This peak to bottom nightmare took about 17 months, or 517 days. The recovery. It took massive, unprecedented government intervention to stop the collapse. But even with bailouts and stimulus, the recovery wasn't quick. From the March 2009 bottom, it took the market about 4 years to climb back and surpass its 2007 peak. The whole journey from peak to trough and back to a new peak took roughly 5.5 years. Historical lesson. The 2008 crisis shows how a systemic event can lead to a terrifying crash. That 17-month slide to the bottom is a crucial piece of data, falling right in line with the historical average for a recessionary bear market. It teaches us to keep an eye on the health of the banking system itself. Case study 4: The COVID-19 flash crash 2020. This one was a total outlier, a bear market in fast forward. The setup. In early 2020, the world slammed into a new coronavirus. The realization that governments would have to shut down entire economies sent a shockwave of pure uncertainty through the markets. The fall. The market peaked on February 19th, 2020. What happened next was the fastest crash from a record high in history. In just 33 days, the S&P 500 plunged 34%, hitting its bottom on March 23rd. The speed was breathtaking. The recovery, the response was just as dramatic. The Federal Reserve and governments globally unleashed an unprecedented flood of money into the financial system. This fueled an equally historic recovery. The market roared back, and by August 2020, less than 5 months after hitting the bottom, the S&P 500 was already at a new all-time high. It was the fastest bear market recovery ever. Historical lesson. The COVID crash was an event-driven bear market caused by an external shock. It shows that when the underlying economy is actually fine and the policy response is overwhelming, recoveries can be incredibly fast. But this is a dangerous lesson. Relying on a repeat of 2020 is betting on a perfect storm that may never happen again. Case Study 5. The 2022 Inflation Bear Market. Our most recent downturn gives us yet another flavor of bear market. The setup. All that stimulus used to fight the COVID recession had a side effect, inflation. Combined with supply chain problems and the war in Ukraine, inflation surged to 40-year highs. To fight it, the Federal Reserve had to do the one thing markets hate: hike interest rates and hike them aggressively. The fall of the S&P 500 peaked on January 3rd, 2022. As the Fed started its rate hiking cycle, stocks began to slide. The market officially became a bear in June 2022, and it was a slow, grinding decline for most of the year. The bottom was finally hit in October 2022, after a drop of about 25 to 27%. This trip to the bottom took roughly 9 months. The recovery began once inflation started showing signs of peaking. The market hit a new all-time high in January 2024, about 24 months after the initial peak. The recovery itself took about 15 months from the bottom. Historical lesson. The 2022 bear market was a classic policy-driven downturn. It wasn't a bubble or a systemic crisis. It was a direct result of the central bank's fight against inflation. Its 9-month slide to the bottom and its 25% drop were much closer to historical averages than the 2020 flash crash. It taught us a valuable lesson. As long as the Fed is aggressively raising rates, it's incredibly tough for the market to find a sustainable bottom. So, after that tour through a century of market chaos, what have we learned? While every bear market is different, the data gives us some powerful averages that can become the bedrock of our strategy. Let's break down the numbers. First, the average decline. Across all bear markets since 1929, the average peak to trough loss is around 35%. Some are way worse, like 2008's 56%, and some are milder, like 2022's 25%. But 35% is that historical midpoint. That number is critical. It tells us that if the market has fallen 20%, history suggests there could still be a long way to go. Second, and maybe the most important number for our timing question, is the time to the trough. How long does the pain actually last? Looking at bear markets since World War II, the average time from the market's peak to its absolute bottom is about 12 months. Some studies find an average of 349 days, or about 11.4 months. The median time, which is often a better number because it's not skewed by outliers, is about 8 months. This tells us something huge. Finding the bottom isn't an event, it's a process. On average, it takes the better part of a year for the selling to finally burn out. The 33-day collapse in 2020 was the exception, not the rule. The 9-month slide in 2022 was far more typical. Third, the time to recovery. This is where things vary the most. A full recovery, meaning the market gets back to its previous high, takes an average of about 2.5 years, but the range is massive. The COVID crash recovered in under 5 months. The 2022 bear market took about 2 years. The 2008 crisis took over 5 years, and the dot-com bust took over 7 for the S&P 500. This tells us that while buying near the bottom is a fantastic move, you have to be prepared for a long wait before you see new highs. Finally, we have to consider the economic context. The data is crystal clear. Bear markets that come with an economic recession are significantly worse. The average drop with a recession is 35% versus just 27% without one. They also last longer. This makes tracking key economic numbers like GDP and unemployment a crucial part of our toolkit. So, What's the big takeaway from all this? Trying to perfectly time the bottom on one specific day is a fool's game, but we can use history to identify a window of maximum opportunity. The data suggests that the period between 8 and 12 months after a market peak is often where the best deals are found. It's in this window that the market has historically been closest to its ultimate bottom. This doesn't mean you blindly throw all your money in on day 240 of a downturn. It means this is when you should be paying very close attention with a plan ready to go. All right, we just crunched a ton of historical data. If you're finding this data-driven approach to investing valuable, do me a favor and hit that subscribe button. We put out videos just like this every single week designed to give you actionable, evidence-based strategies. And if you want to go even deeper, I have a weekly newsletter where I share one piece of market analysis and one practical investing tip. The link is right down in the description. It's completely free, and it's the best way to stay ahead of the curve. Knowing the history is one thing. Acting on it when there's real panic in the air is another. A pre-planned mechanical strategy is the only way to fight the fear and greed that trip up so many investors. Here are 3 practical strategies, from simplest to most advanced, for how to actually do this. Strategy 1, the automatic investor, dollar cost averaging, DCA. This is the simplest, most effective, and most psychologically sound strategy for the vast majority of people. Dollar cost averaging just means investing a fixed amount of money at regular intervals, no matter what the market is doing. For example, putting $500 every single month into an S&P 500 index fund. Why is this so powerful in a downturn? It forces you to buy low automatically. When the market falls, your fixed $500 buys more shares than it did the month before. When the market is high, it buys fewer shares. Over time, this lowers your average cost per share. The beauty of DCA is that it takes emotion and market timing completely out of the equation. You don't have to guess where the bottom is. You just keep investing on schedule. During a grinding 12-month bear market, you'll be automatically buying shares at lower and lower prices, near the bottom and on the way back up. It turns market volatility from something to fear into an advantage. Strategy 2, the tactical investor, staggered, rule-based. Buying. This is a more active version of DCA for investors who have a lump sum of cash ready to go. Instead of trying to time the perfect bottom, you break your cash up into pieces or tranches and invest them based on preset market levels. Here's a simple framework, the rule of thirds. Let's say you have $30,000 in cash you want to put to work. First tranche, $10,000. You invest the first third after the market officially enters a bear market. So after a 20% drop, this gets you in the game. You've accepted you won't nail the bottom, but you're buying at a major discount. Second tranche, $10,000. You deploy the second third when the market hits a deeper level. You could set this based on the historical average. For instance, you could invest this part when the market is down 30 to 35%. This lets you take advantage of more downside and lowers your average cost. Third tranche, $10,000. You save the last third for either extreme panic or signs of a real recovery. You could deploy it if the market drops to a crazy level, say 45 to 50%, which is a generational buying opportunity. Or more conservatively, you could wait until the market has clearly bounced and is, say, 15% above its lows. This strategy gives you a clear, emotion-free plan. It keeps you from putting all your cash in too early while making sure you take advantage of the sale as it gets better. Strategy 3, the confirmationist, watching for the follow-through day. This is a more advanced technique, made famous by investor William J. O'Neill. It's not about catching the absolute bottom. It's about confirming that a new uptrend has actually started. So you reduce the risk of buying into a fake rally, often called a bear market rally. Here's how it works. After the market has been falling for a while, you watch for an attempted rally. This starts on the first day a major index like the S&P 500 closes up from its low, then you start counting. A follow-through day, FTD, is the signal. It has to happen on day 4 or later of the rally attempt. A follow-through day is a single day where a major index closes up big, say 1.5% or more, on higher trading volume than the day before. What does that mean? The strong gain on bigger volume signals that institutional investors, the big money, are getting back into the market with conviction. It's a sign that the market's character is changing from selling to buying. A follow-through day isn't foolproof. Some of them do fail. But historical analysis shows that no sustainable new bull market has ever started without one. So, waiting for an FTD before you invest serious money is a powerful way to increase your odds of success. It's a strategy based on evidence, not guessing. We started with a simple question: when do you buy the dip? And after looking at a century of data, the answer isn't a date on a calendar. It's a strategy built on history and discipline. The emotional response is to buy after the first sign of trouble. The data shows that's usually a mistake. History tells us that bear markets take time to play out, with the average trip from peak to bottom lasting anywhere from 8 to 12 months. The average drop is a painful 35%. Knowing this is your shield against acting too soon. The key takeaway is this: timing the exact bottom is impossible and a psychological nightmare. The much better approach is to have a plan made when you're calm that you can execute like a robot when there's chaos. For most people, that plan should be dollar cost averaging, the steady automatic investing that turns volatility into your friend. For those with cash waiting on the sidelines, a staggered buying strategy, investing at preset levels like minus 20% and minus 35%, gives you a logical plan that keeps you from going all in too early. And for the more advanced investor, waiting for a follow through day is a powerful confirmation that the big money is back in the game. Market crashes are not something to fear. They are a normal part of investing. They are how assets get transferred from the impatient to the patient. History has shown, without a doubt, that every single bear market has eventually been followed by a new bull market and new all-time highs. Sometimes the recovery is fast, like in 2020. Sometimes it's a multi-year grind, like after 2000 and 2008. Your job isn't to predict the timeline. Your job is to use the downturn to buy shares at a discount so you're ready for the recovery whenever it comes. The next time the markets are bleeding red and the headlines are screaming sell, you'll know better. You'll remember the data, you'll have your plan, you will be ready to get greedy when others are fearful. And that is how you actually and successfully buy the dip. What's your strategy for a market downturn? Have you tried buying the dip? Share your experience in the comments below, the good, the bad, and the ugly. Your story could help someone else here become a better investor. And if you found this guide valuable, don't forget to like and subscribe for more. Thanks for watching.